All right, this is the last installment in the introductory material here. So we pick up more or less we left off the last one with financial statements. Again, the idea here is, I'm going to go back to a slide you've seen before, is whatever you were doing here, like this is great, but again, if you just dump this in someone's lap and say, what is, please, interpret it, they're probably going to be a loss. So that's where financial statements are going to come to the rescue here. So we're taking all those transactions that have been booked, and again, we're going to summarize them. And again, the increments of time that you can work with here, you can do monthly. Oops, just paint over the word there. You can do month by quarter, so 3-month period, or a fiscal year, which is any 12-month period other than a calendar year. So some businesses resort to that because their business cycle makes sense for them to not just do January 1 to December 31st. Like, for example, if your business is holiday oriented, meaning you do a lot of business in December, you're probably not going to want to try and do a year-end close at the end of December because it's just ridiculous. It's too hectic. So they'll probably choose February 1st through January 31st as their cycle, but it's still 12 months. All right, so as far as what you have to report by U.S. standards, and again, the Financial Accounting Standards Board, abbreviated as FASB, requires all corporations to issue 4 basic financial statements. And this is the order in which they should be prepared, by the way. So you have your income statement, statement of retained earnings, balance sheet, and then lastly, statement of cash flows, which we don't flesh out until the very end of the class. We'll talk briefly about it here, but just a cursory coverage. Now, each of these has an underlying equation, which we'll discuss one at a time. But in the case of the statement of cash flows, what you'll see is it has a check figure, meaning it's just, we have a way of just, saying this is the amount that you're shooting for, and then at the end of the statement should equal this. So that's a little different than the other 3. All right, so first we'll start with where we always begin here, which is the income statement. So a little semantics for you here. This is the normal way you would see this statement headed up. You would have the name of the business, the name of the statement. Obviously, this wouldn't be in there in a normal income statement. That's just there letting you know that, hey, this is the first statement to be prepared in order. It's just a learning device. And then you would have basically alerting the user of this statement, like, what are we talking about? What increment of time? So this is for month end. So this is just for 1 month period we're talking, November 30th of 2019. All right, so your basic equation for the income statement is right down there. It's just take your revenues minus expenses. If you get a positive number, net income, negative, that's why it's in brackets, we call that a net loss. Now, just to sort of expand on revenues and expenses, so let's, taking that information that was, presented in the previous video. So think of it this way, it's earned revenues minus incurred expenses. You can expand it out to that. Why do I emphasize that? Because you'll notice that those 2 definitions don't include cash. We don't care about cash. We're not measuring cash here because some part of your revenues may have been earned, but you maybe haven't received them in cash already. And as we go on in the class, you'll see that the idea behind, like, when you recognize revenue, when it's earned. So it doesn't matter if you got the cash at the same time as you earned it, you got the cash in advance, or you get the cash after it's earned. Doesn't matter. It's earned is the standard that we're going to abide across the board. Same thing is true for expenses. Not every expense that you'll have incurred necessarily is something you paid cash for. So again, we'll give you a formal, excuse me, I'll give you a formal definition for what kind of accounting we're doing, but that's going to be in a later video. All right, so for this example, were our revenues. Our revenues were fees earned right there, and that totaled $65,000. So we're just going to plug that number in like so. And in this case, in another video, we'll talk about what operating expenses are, and I can give you the short answer right now. Almost all your expenses in the business are pretty much operating in nature. We'll talk about which ones aren't in the account classification video, but for now, so it's reasonable to say the ones we had here, which was repairs expense and supplies expense, which was the $5,000 and $2,500. Those are operating expenses, so I just listed them out right there, as you would imagine and any other company would do. And they total $7,500. Take the difference, and you get $57,500 as your net income. Now you'll notice that I bolded this amount because this is what you're going to observe. That again, why do we do the statements in this order? Because it's the logic of the way that they flow one into the other. That's just the way that they're designed. So I will take this and say, okay, this is going to flow. I'll have to go to the next slide here. All right, and this one flows here to the statement of retained earnings. So again, continue my arrow from the other slide. So there's where you'll see it right there. So there's the connective tissue, so to speak, to the next statement of retained earnings. Now again, this also has an equation. In this case, it's going to be the beginning balance of retained earnings plus a net income or minus a net loss, and then minus dividends will equal your ending retained earnings balance. Now just go over the semantics quickly here. So again, we have name of the company. We have name of the statement. Again, it's second in order that we prepared, and you'll notice it has the same semantic as the income statement for month ended November 30th, 2019. So since this was a new business, I'll just take that out of there so it's not a distraction. We start at 0, so that's why you just have a 0 there. So our net income that we derived from the previous statement minus dividends. Again, I'll go back a couple slides. So again, there was the dividends that were paid during the period, $25,000. So because of this, you take the difference between net income minus dividends, you'll get a net increase in retained earnings, a net change, you can refer to that, more kind of a mathematical terminology, of $32,500, which also equals the ending balance because the beginning balance was 0. Now, a thing to note about this statement here is, again, we don't discuss investments are not included in this statement. Again, all we care about is analyzing what happened to retained earnings during the period. What did it start as? Did we have a net income or a net loss? Did we pay any dividends? What's the resulting ending balance? If you want a full analysis of shareholder equity, you got to look at statement of stockholders' equity, which we don't really emphasize in this class, but I think you can usually find it somewhere in the textbook, just as FYI. All right, so we're in the same boat as we were before with the income statement, that what we just did here flows to the next statement. So in this case, I can stay on the same page. So that's going to be the balance that gets reported for retained earnings on the balance sheet. All right, so the balance sheet, again, we'll go over the semantics of that. So we got name of the company, check, balance sheet, third in order. Now notice there's a little change in the semantic here. November 30th, 2019. Nothing about saying for month ended like you had up here and as you had on the income statement as well. So what's accounting for that difference? Or like why do we address it differently? Well, the difference is the way to look at those two previous statements, income statement and statement of retained earnings, is what they were doing is they were saying this is what happened to the company from the beginning of November to the end of November with regards to net income and with regards to your retained earnings balance. So that's why we say for month end, we're indicating a period of time. So we're just saying, like, how did things change? When you get to the balance sheet, all you're doing there is reporting what's true at a single point in time. So in other words, all we care about here is, right, here's our point in time, is what was the balance of your assets, liabilities, and shareholder equity on that specific date, on November 30th. It's not telling you what was true the day before or necessarily what will be true the day after. So it's at a point in time. So that's why we address it differently, because that's the way it's just saying at a point in time this is what we're reporting. Now, do you already know the equation for this? It's the accounting equation. So all we're doing is basically just saying, based on the accounting equation, our total assets should, of course, equal our liabilities and shareholder equity. So it's, in a way, it's kind of a check, but it's also a rundown of the balance of those accounts. All right, so here, all you're looking at is whatever our balance was down here with regard to, okay, cash. I'll just do a little cleanup on this. So it just says, okay, what was the balance in cash? $781.5. That's what we have there. Accounts receivable, of course, was nothing, so we got nothing there. Supplies at $1,000, $250 for trucks. We'll see all that to be true. I put accounts receivable in there even though it was a zero balance just for completeness sake. And then we just total it up. So we get our total assets, $1,032,500, Okay, and then we look at the other half of the accounting equation. So accounts payable had a zero balance, $1 million in common stock, and of course, in this case, for the missing last component, the missing piece is the retained earnings balance. We're going to regard whatever the balance was in the retained earnings statement, because it really doesn't exist here. I mean, if you took all this right here and you netted it, you would get the balance, but in essence, it really doesn't exist anywhere else except on the retained earnings statement at this point. And that will become more clear when we go to basically like later when we're doing something called the adjusting entries and basically finishing up the accounting cycle. You'll see exactly why you kind of have to rely on the retained earnings statement as your definitive source at this point in the process for what the balance of retained earnings is. So we got our million there, and then whatever the above statement says, statement of retained earnings told us, add it, we get the same 1,032,500. All right, now, again, this is a pretty short trip, so I had a couple of notes here. You saw A there and B there, and it just refers to what I have on the next slide. Oops. There it is. Having some technical difficulties with this, so I did not load them previously just to make sure that I was going to get a working version of this video. All right, anyway, so just referring to those notes. So again, A is just saying net income flows from the income statement to the statement of retained earnings. And then B is just letting you know that the balance of ending retained earnings flows from that to the balance sheet. So again, that's why we think of those being done in that order. You know, income statement, statement of retained earnings, balance sheet, because of the flow of them. You have to do the income statement before you would technically do a statement of retained earnings. You have to do that before you would do a balance sheet, because that's just the nature of what you're doing here. Now, just a quick synopsis on the statement of cash flows. This will be divided into three sections here. Right? And the sections are the operating, investing, and financing activities. So what I did here is I did sort of a sketch of if you were doing a formal statement of cash flows, what you would get in each of those sections based on the analysis. Again, you don't have to understand what that analysis is right now, but just that those are the three sections. And again, what are you doing? You're explaining how did we go from cash, which was, remember, this was a zero balance. We had no cash on hand because we didn't exist. The business was just a startup. And how did we end up getting to 781,500? And so that's what this statement of cash flows is explaining. It's saying, okay, from your operating activities, you derive $56,500. Investing, you use, there's a minus sign there, you'll notice. You use $250,000, and financing provided $975,000. So if you net all those together, you'll get exactly 781.5. So that's all that statement of cash flows is doing. It's just saying, like, where did you get that ending balance of 781.5? Where did it come from? And again, we'll flesh out exactly what those concerns are in vastly more detail will be in the last chapter of the class. So it's kind of, again, referred to as a check figure. If you don't get that amount and you add up those three sections, because that's, again, how much it went up by. Also, it's ending balance because it started at zero. If you don't get that, that means you forgot something. So that's why I always refer to it as a check figure. So that's the only statement that has a definitive amount that you're shooting for before you complete it. All right, that concludes the introductory material videos. The next one up in sequence, we'll be talking about debits and credits, or depending on what version of the book that we're using, the next one in sequence that you might be relying on could be account classification. So for the current incarnation when this was created, it would be account classification. For the next version of the book, it's going to be referring to debits and credits. But I would actually urge people to probably still look at that one beforehand, because it's kind of the nature of the beast that you sort of have to do account classification before you delve into debits and credits, because something called the chart of accounts comes into play. But the way the new textbook is organized, you'll see that it gets pushed into a later chapter. But the way to look at all the videos I'm presenting in the introductory material is that, you know, regardless of how the book organizes it, all those videos, when added up, will equal in total whatever that material is. You know, maybe some of the order might be a little bit different, but the basics are still the basics, regardless of how a textbook decides to arrange it. And in my experience, the account classification is kind of a necessary step before you can wade into the debits and credits material. So that's why I would say, even if the book puts it off until a later chapter, chapter 4 is the one that would be in the next version of it, I'd still recommend that you probably look at that one next anyways. All right, so that ends this video, and And see you later.